The United States of America has just lost its perfect AAA credit rating from one of the big rating agencies, Moody's. Here's why it's important. First of all, was this a surprise? No. Everyone's been talking, particularly since the COVID stimulus, that US public debt has just become much too high, now equal to about 100% of the United States economy. And in 2024, interest payments alone cost the US $880 billion. Number two, does this crater the markets? We're seeing already that the indices are flat to slightly up. Also, we can look back to see what happened in 2011, which is when another rating agency, Standard & Poor's, cut the United States of America's credit rating. In that instance, the major US equity markets dropped by about 6%, but they did bounce back relatively quickly, and here's why. Even though the outlook for the US wasn't what everyone wanted, it was even worse for other major geographies like Europe, which meant that capital still flowed back into the US equity market because it seemed to be the safe haven. The key takeaway being, what happens to the US in a vacuum isn't the only important thing, it's how is the United States doing relative to other economies. Number three, does this impact the cost of credit for corporations and for everyone like you and me? And the answer is yes, and this is the piece that I'm really focused on. With a lower credit rating, that means that the risk of US Treasuries is perceived to be higher, and higher risk usually means higher cost of borrowing. And if the cost of borrowing for the US government has gone up, it's gone up for everybody else too, from companies to individuals. That's why what you're seeing in response to this is certain sectors are down right now. That includes the banks, and it includes things like the home improvement stores like Home Depot. These are the more interest rate sensitive sectors, and that's why they're the sectors we have to watch most in response to all of this.